866-893-5722 to let us know. Robert Satnick joins me. He's president of the California Mortgage Bankers Association and president and CEO of Prime Financial Services in Van Nuys. Thank you so much for being here again.
Hello, Pat. Pleasure to be here.
So from what you have heard of or read about the president's plan, how does it strike you as how effective it's going to be and how useful it's going to be to you and your fellow mortgage bankers?
Well, of course, it's a little preliminary and early to determine exactly what impact it will have, being that it was just released today. But I think we're glad to see that a plan is being put in place to help homeowners before they fall behind on their mortgage payments. He outlined a proposal on a plan and an implementation strategy to help get capital flowing again, not just to people who are already delinquent in their mortgages, but to the tens of hundreds of homeowners who are struggling and still keeping up with their payments, but looking for some alternative and trying to help them, even though they don't have the values that they need to try and refinance at today's lower interest rates. So we see this as a step in the right direction to help folks get back on track, restructure their personal financial situation, and help them start investing and spending money in the economy. And face it, once we get the consumers confident again and start spending, that's what's going to help us get out of this recession that we are all suffering from.
What about the provision that would allow judges to reduce the mortgages, the principal on primary homes to what's called fair market value and put the borrower on a court-ordered repayment plan? Does that throw a wrench in the works for you?
Yeah, I would have to be honest and say that has, as a professional in the mortgage industry with 20 years experience, that certainly is a lot of concern. What can it do to future capital that comes into the market and investors, both domestic and international, their ability to want to invest in our securities and our mortgage-backed securities and continue keeping capital flowing? If they think that there isn't that the courts can just negate any of their contracts and take away their ability to earn a return, they may decide not to continue spending and investing in our economy. So I think the long-term ramifications can be possibly much more detrimental than the short-term benefits that some believe may be achieved from that.
And what about the shaking out of the kind of flipper and speculator client in the housing market? Is that ultimately going to be a good thing, or is this going to creep back in, do you think, and create some problems?
Well, as your previous speaker addressed, we're never going to find a one solution to benefit all buyers and borrowers. No matter what system you have, there's always going to be somebody who's trying to benefit from someone else's failure and someone trying to cheat the system. What's nice here about this plan is they are targeting a way to help those folks who have been trying to play by the rules but have not been able to find any other solution. He's focusing on primary residences, owner-occupied properties, how they came about to get into that property and the loans. At this point, it doesn't matter. There's so much blame that could go around, and we've talked about that on previous shows. That is hardly the issue anymore. What really needs to be the issue is what can we do today to help free up capital, to help people get their financial situation back in a way where they can afford their payments and move forward and start spending again and going back to creating some growth for our economy.
Sean's question was what the plan does for new homeowners. As I read it, it tries to keep the mortgage rates low for middle-class families who are trying to get into the market or trying to get new mortgages. Is that just as important as keeping other people in their homes?
Absolutely. We want to continue to have programs that are available to new homeowners, to new buyers. There are a number of programs out there, but I think the one thing that the industry has learned is there's no substitute for making sure that people do have some skin in the game, that they put some amount of deposit down of their own money so they have some vested interest in owning the property and maintaining it, and clearly doing the proper analysis on their ability to afford the payment and their willingness to continue to make the payment. And I think that is an area where we kind of started to stray from those original rules of what lending was supposed to be, and we have now returned to those standards. And so that, in the long term, is a positive. But, rates are something that are determined by the free market system, by the capital markets, and by helping to get homes sold, get the inventory of foreclosed homes moving again, try and keep homes that are at risk from going into foreclosure will help stabilize prices, and in turn will help keep rates down and help everybody get moving along again.
Now, traditionally, the budgeters would have told you that you should shoot for paying a third of your income for your mortgage or your rent. That just hasn't been possible in a lot of markets like Southern California. David in Pasadena has a point on that. David, thanks. You're on the air.
Yeah, I think the 31% number in the plan is, to me, the most appealing part about it, because if you look at the median income in Southern California and the median house price, even still, is way out of whack. So if we get to a situation, if this aspect of the plan becomes standard once again, where mortgage lenders look at a person's income and say, is that income in a proper relationship to what the mortgage payment is going to be, housing prices will settle at a level that is affordable for more people. I think this is a fantastic plan. I think and ultimately, these will be more stable to address the mortgage bankers' concern. These will be better mortgages, and they'll be easier to sell because they're a better investment for investors long term.
Think it's a good plan?
Well, again, I don't know if this is the best plan or not the best plan. It's a little bit early to tell, but his point is well taken. We are at a point now where property values have dropped sufficiently enough that in many markets, we're at a point where at current interest rates, it makes more sense to own a home than to rent. For a while there, it got to the point where the price spread between renting and owning was so great that because the whole affordability was so expensive for the homes. Home prices have fallen enough and interest rates have fallen enough that now people can't afford to buy homes based on today's income using the traditional means that we followed. And that is, in fact, a very good thing for us in the long run.
David, thanks for your call. Lou in Northridge weighed in on the Pat Morrison blog. He says Obama's a hypocrite. He claims to be for the working and middle class, but wants to keep the number one cost for us, which is housing, high, so he can score political brownie points to be the savior of foreclosures. If these people were responsible in the first place, they wouldn't have gotten a home they couldn't afford. Does this then, Robert Satnick, as you alluded to, change the dynamic, the definition of affordability?
Well, I think the point there being that I talk to probably 100 folks a month that are looking to refinance, and they're still making their payments, but they've suffered pay reductions, or a spouse has lost a job, and they're suffering, but they're still trying to make the payment. And they put $200,000-$300,000 down on a property, on a home that they thought was a good investment and a place for their family. And what they have found is there's no place for them to turn, and now there's an opportunity for them to possibly get some relief in terms of a modification. So there are a lot of people that have really played by the rules, and this will help them so that they can avoid foreclosure, keep their homes. They're not necessarily looking to get their money back. They're not necessarily even looking for a forgiveness of debt. They're looking for just to help restructure their payments plan so that they can afford the payment based on what has happened in the economy by no fault of their own. So to that extent, there is some positive aspects of the plan. The real question is going to be, and more will be unveiled as we get closer to March 4th when we see how it really is going to be implemented and what the process will be for getting that relief to these folks.
Are you and your colleagues, your fellow mortgage bankers, essentially sort of taking a long, deep breath or letting go of a long, deep breath just because something's happening on this front?
There's probably a fair amount of truth to that. We're glad to see something positive, something that reaches down to the level of the consumer and get something rolling for them. So yes, there's never going to be a perfect solution that's going to appeal to everybody. This does appear on the outset to be a fairly middle of the road. What we do want to encourage is that, to the extent possible, our state legislature takes a wait-and-see approach and lets the federal plan be implemented and doesn't pass any legislation that could possibly be adverse to that and cause further problems, such as additional moratoriums on foreclosures and whatnot. One thing that is critical in any business cycle is to keep the inventory moving, and while we don't want to see more foreclosures, at the same time, we don't want to have a stoppage because that just projects the problem down into the future and doesn't solve it.
Mr. Satnick, thanks as always. Maybe we'll come back to you after that March 3rd date and find out how it looks from then.
Terrific. Would love to come back. Thank you.
Robert Satnick is president of the California Mortgage Bankers Association and president and CEO of Prime Financial Services in Van Nuys.